All right, well, good afternoon. I want to thank everyone for joining us today as we have our webinar as follow-up to the 2024 presidential election. I'm Lindsey McKay, owner and lead advisor with McKay Wealth Management, for those of you that don't know me. And I'm joined today by Rachael Crane, who is one of our portfolio managers with City National Rochdale. For many of you, Rachael is a familiar face. We get updates from her throughout the course of the year. And her and I were just talking about kind of what we've been saying leading up to the election to what the outcome of the election was, and, really where do we start the conversation? So we're going to start a little bit with, sort of what was anticipated versus where we're at. And then we really want to encourage questions from the audience. So if you have something that's on your mind about the election, that could be tariffs, taxes, debt. There's a whole gamut of things we could dig into. So if you have anything that you want to make sure we address, please put that in the question and answer box. And with that, I'll bring Rachael on to start the conversation.
Wonderful. Thank you, Lindsey, and hello, everyone. It's always a pleasure to speak to this audience and to give you a little bit of our insight on what's going on in the world. Now, when Lindsey and I planned this, we had been talking about an expectation that we probably were going to see a good amount of market volatility. We were probably going to see a split Congress, and we thought that maybe we would have an unknown outcome for some amount of time. That was kind of the base case scenario. That's actually not where we're at all. In fact, what we've seen is a clear outcome. Republicans have taken control, and the market has been pretty calm about the whole situation. So I want to dig into what's gone on there, what we think about the points that Trump campaigned on versus what we think can get passed. And then, as Lindsey said, of course, I'd love to hear from any of you out there, any questions specifically. Now, what happened also, not only in the election, but we had a group of data all compressed into 1 week. We got a jobs number, which was 12,000 new jobs created, not significant, keeping in mind that in October, the jobs report was 200,000 plus jobs created. So the November jobs data came in, then we had the election, and then we had a Fed meeting. And in the Fed meeting, we got another 0.25% interest rate cut. So when we talk about what the market reaction has been, it's actually been to a combination of data points that came in all in a short moment. We are looking here just to give you a macro perspective first before we dig into details about where the economy is at. And based on the economic and financial indicators, looking forward 6 to 9 months, where do we expect the economy to be? And the reason why I wanted to start with this is because the market and the economy work together over a longer period of time, but the market can respond to a lot of short-term data points and variables that the economy is much slower to move. This is our October data set. We actually just got a new one, but didn't have time to get it in for compliance. But I wanted to highlight that we actually have 2 additional green speedometers since our last version: fiscal spending and the business outlook. This is a combination of both the outcome of the election and that Fed meeting. But here's what we're seeing right now. We're in an economy where consumers drive GDP. About 70% of the GDP number comes from consumption. And consumers have been spending. And we've been spending for 2 reasons. One, because we're working and we've seen wage growth, and we have a little bit psychologically of a eat, drink, and be merry, because who knows what's going to happen next. We still have that COVID PTSD a little bit. We're spending because things cost more, so we have to use a lot of our income and discretionary income just to cover costs. We also feel pretty good about the fact that we have a job and that jobs are available and fairly secure in the labor market. And this is the basis of a healthy economy. that labor market is really the linchpin around a lot of other points. One of the reasons why we're thinking about the labor market so much is because one of the key points that's tied to it, besides consumption, is monetary policy. The Federal Reserve has two mandates. One is to have healthy unemployment, so that's roughly around 4% unemployment, and to have low inflation, which their target is about 2 to 2.5%. When interest rates went up, it was to combat the fact that inflation was at about 9%. Well, now we've had that inflation number coming down, and the Federal Reserve is moving towards a more normalization in the economy. Separate than the election, separate than the outcome whatsoever, this is a positive data point for the economy. The Federal Reserve moving interest rates down. It takes off some of the tightening policy and is not yet stimulative because we still have to move down in rates to get to a stimulative point. It's certainly less restrictive. The market likes that. Historically, when you look at lowering interest rates, the S&P 500 does well 6-9 months following that first interest rate cut. The election has added to, and really the control of Congress has added to a sentiment that we're going to have more spending. On the positive side of that, that's stimulative to the economy. On the negative side of that, that contributes to an expectation or the actual deficit. We're going to talk through a lot of those points in more specifics of how that plays out. But the market's reaction to this clump of data together has been positive. That on a net basis, the good, the bad, the ugly, combined with the stimulus that we're going to see, that we're likely not headed for a major cliff in the economy, and that the economy is still healthy enough to continue to grow, and that the administration policies will not derail the economy at this point. Now we're in early days, so there's a lot we don't know. We're going to have to play out some of these policies we'll get into, but that's initially been the market's response to this outcome. I want to touch on just these two red indicators, and then Lindsey, I know you have some questions for me. The first one I want to touch on is geopolitical risk, because this dial is always red. And the question about the election is, does this increase or decrease or have any impact on geopolitical conflict and risk? Again, that's pretty early to tell. We'll talk about that as it relates to tariffs and other commentary by Trump in campaigning. But unlikely that the election itself would have reduced the geopolitical risk we're experiencing. And then the one red indicator here is equity market valuation, that stocks have had such a great year, a great 2023, and even better 2024. Now, when we look at across sectors, the kind of returns we're seeing, stocks aren't cheap, but those returns are rooted in a good amount of economic growth expectation and positive corporate profits. So we look at this mix of data here, knowing we've got two more indicators that are green. And our message is we don't see a major cliff on the horizon. The economy should continue to grow. And barring a geopolitical shock, we still think investments will be rewarded looking into 2025. So with that kind of summary, Lindsey, I know you have some questions for me.
Yeah, Rachel, let's start with, talking about monetary policy. So you mentioned that we've seen, a rate cut happen post-election. What are we seeing forecasted as far as, are we still expecting the same amount of rate cuts? Is there an acceleration in how quickly we'll see rates cut? What has been kind of shifted now that we know the outcome of the election and that kind of red wave that came with it?
Yeah, so great, important questions. And I kind of want to take one step back, which is to say rate cuts in any form tend to be positive. And what this chart is showing is the S&P 500 performance before and after the first Fed rate cut. So Lindsay, your question's important. It's okay, so what's the pace at which we're going to see those rates come down? And the outcome of this election has actually put that into question a little bit. But it should be positive, just the fact that we're headed in that direction. What this shows is the number of days following the first rate cut through 487 days, on average, what we see in the S&P 500. So overall speaking, Fed easing cycles tend to support consumer spending, corporate spending, they boost economic growth. And if nothing else, they really withhold that tightening that we've been dealing with. The biggest thing that changed though is the outcome of the election is really surrounding the policy that's expected to come from a red wave. And we broke this out into these potential policy changes. And I want to be careful here because we are early on. A lot that people campaign on is not necessarily what they try and pass or actually can get passed. Though Republicans do have a majority, they don't have such a huge majority that it's easy days. But when we look at the potential policy change, this is where the Federal Reserve is going to be really focused on, is inflation and policies that contribute to higher or lower inflation. I talked about the market's response to the election, and I was really talking about equities. When we look at the bond market, one thing that happened is the longer end of the curve, if you think of 10 or 30-year interest rates, those rates actually went up following the election. Well, how does that make sense? The Fed's cutting rates and long-term rates are going up. Well, those long-term rates are tied to inflation expectations. So investors today are expecting that the policy of this red wave will likely lead to higher inflation for longer, which therefore would then reduce the rate that the Federal Reserve can cut the Fed funds rate, the speed at which they can cut. So that has changed. When we got the first rate cut, the Federal Reserve cut 0.5%. They cut again 0.25%. The expectation at that time was we would get another interest rate cut this year and 4 more next year. Expectations have come off of that a little bit. The Fed's probably going to be slower. They're going to want to know what kind of spending is coming out of the administration. And if that spending leads to higher inflation, that they can't cut rates too quickly. Otherwise, then it's sort of gone against this soft landing that they're trying to achieve.
Well, since we're on this slide, I feel like we should just hit on all of these since this is the matrix that summarizes some of the other points I know that we were planning to make. But let's start with the top and talk about tax rates.
Yes, so important. So we all know that the Trump Tax Cuts and Jobs Act is set to sunset at the end of 2025. This was the package that Congress put together at the end of 2017 when Trump had begun his administration. He also had control of Congress, and the market was anticipating lower tax rates. That got pushed through and approved, and it was approved to go from 2018 through 2025 with a sunset at 2025. Coming into this election, I would say this is the policy that we were all thinking a lot about, that if Congress does nothing, we have a sunsetting of the current tax code, which basically raises tax rates across all brackets, reduces a lifetime exemption, and has some impact on corporate tax rates. Now, it's likely some amount, if not all, will get extended. The amount that it gets extended, though, will have to be balanced by the impact on the deficit that it creates by not having that tax revenue. So some of the specific data points about here is that if we're going to continue to spend, right, and the administration, though, to be fair, both sides of the aisle, we're talking about being committed to spending. So I guess we can't only blame the Republicans, but with the Trump extension, it will likely cost about $4.6 trillion is the number to extend um, all of the all of the policy. So how do we do that without increasing the deficit in a way that it becomes prohibitive? And so it likely won't completely get extended, but pieces here and there will probably get extended and some won't. The good news is that it means that there's a little bit less urgency in rushing to get your estate planning done for those of you who are in that net worth bracket that's above the lifetime exemption. But there's also a couple of really other interesting things that comes from this. Big picture, Trump has been pro-business from a tax perspective, right? So lower corporate tax rates immediately go to the balance sheet and go to higher corporate profits. So lower tax rates, higher corporate profits. Lower tax rates means more economic growth potentially, and potentially more inflation, but higher GDP, which means that interest rates don't have as much room to come down. One thing that was also part of this package was basically more money for the IRS to do audits, particularly of the high net worth individuals and households. Some of that money is going to be going away. And so the IRS will have a little bit less power to do some auditing. These are the kind of things that are going to be battled out in Congress. Not all Republicans are in favor, I think, of this 4.6 trillion. I'm guessing, likely at this point. And so my guess is that this reconciliation, this is going to need a majority, and then there's going to have to be some kind of balancing of the budget. So we don't know yet. But the point is that base case scenario, we're likely going to see the extension of the lower tax rates, the higher exemption value, and we're not going to see major tax increases as a result of this election. When we look at tariffs, which is a point that comes up quite a bit and really important economic theory, the one thing about tariffs that most economists agree with is we don't want them. They're not helpful, and they create higher costs. If we could live in a world where there was free trade with everyone and a lot of peace, that's how you keep goods cheaper. The question is, one, is Trump actually going to institute these tariffs that he ran on? How much, if so, if he's going to? How he's going to do it, kind of not needing Congress support, that kind of thing. And also, will he do it in conjunction with some of these other economic pressures? More than anything, I think that this is more of a geopolitical kind of weapon. Even just the threat of tariffs, particularly, is trying to make a statement to China. That as China was a developing economy, the global economy really subsidized a lot of Chinese goods. And that was okay because they were developing and we could outsource our labor for a lower cost labor to China. So it worked. It was working kind of on both sides. Well, now China's not really the place to go for low cost labor. And the global economy, really led by the US, is now saying, you need to pay your own way. We can't keep subsidizing when we still have to go to other countries for lower cost labor. So these tariffs are more of a geopolitical focus. I mean, we don't really want to see increased costs. What's the impact of tariffs? Increased costs. Who does that hurt the most? Usually lower income families that are spending those precious monies on goods, if that's food and whatnot. So we want to be mindful of this. If we are going to see a significant increase in tariffs, we would expect that would be a negative to GDP, higher costs, higher interest rate, and lower corporate profits. The market, if you could just look at it as a silo, the market will not be crazy about higher tariffs. The question will be the balance. Well, what if we cut tax rates but have tariffs so that on a net neutral, the higher GDP that comes from lower tax rates and the lower GDP that comes from tariffs neutralizes each other out so that we don't have to see a major cliff on the horizon. So it's really going to be the whole package. Now, the federal debt, as you see here, is something that the market has already responded to with an anticipation that it's going to create higher inflation and it's going to create higher interest rates, likely neutral on GDP and corporate profits. The federal debt is always a question, but can we keep spending at this rate and that be stimulative to the economy, with the risk of higher interest rates being that the debt payment becomes larger and larger, that starts deteriorating GDP over time. If we have kind of the worst case scenario is higher and higher debt and high interest rates, because the cost of that debt, it becomes a detriment. When we think back on as the federal deficit has gotten larger and larger, it depends on the cost of the debt. When that's happened, when interest rates were low, the debt payment could be neutralized even with a much larger debt load. Well, we need to be careful of that in this new normal of interest rates that are likely not going back to zero. That was an example. And then immigration is obviously a topic for social issues, but economic issues as it relates to the labor market. We know we need a certain amount of immigration to keep jobs flowing. We need employment to be healthy. We need a certain amount of immigration, particularly in the jobs that Americans don't want to have. And a lot of those are in-person jobs. They're often service-oriented. They often can be physically taxing. And you need a level of population that can produce in those jobs. The question here will be the nuance will be the amount of change of immigration. Just lower immigration as a whole, the question will be what type of immigration, how much, but generally speaking, more immigration leads to higher consumption, more GDP. Tightening up immigration has, economically speaking, a negative impact on GDP. Does this show up immediately? This is kind of the big question also, not only the balance of all of these policies, but how quickly do these policies filter through to the economy and then have an impact? It's not always right away. It takes time for the economy to respond to some of these bigger changes. GDP, labor, productivity, and technology together are what produce GDP. And it's going to be some time before we see the impact of all of this. In fact, many economists say you don't really see the economic impact of an administration's policies for years after the administration has left the office. So we are going to have to take this kind of step by step, see what happens, what the administration really goes after, and what extent they go after, and what can be passed. And then we can kind of project better what the impact on GDP will be.
Let's focus on the column of corporate profits, because I think that's really, going to help to segue into talking about the markets. So we have some things that would lead to higher corporate profits, but kind of 2 of the 4 are lower and 1 is neutral. So what are the expectations for equity markets in the near term? As you said, it takes time for all of these policy changes to have impact, but we also know that markets love to react. So what are we expecting to see? Maybe not so much for the last 6 weeks of the year, but for 2025 as we turn the corner to a new calendar year.
Yeah, great question, because it's really all about corporate profits. That's what we're buying as investors, is corporate profits today and our expectation of how much those are going to grow. Now, this chart we created before the election to kind of talk through the key events and getting through an election because of that uncertainty of what would the outcome be. But I wanted to just stop on it because even in the policy debate, there's a lot of anxiety and uncertainty about what this all means. And we haven't seen a lot of volatility, but volatility tends to subside and get back to normal about 60 days post-election. That volatility is the market trying to interpret, what does all of this mean? And companies saying, okay, we need to know, what are the rules? Costco and the management of Costco, they just want to know what the rules are. Are corporate tax rates going up? Are corporate tax rates going down? If they're going up, we need to think about the impact. Are we going to have tariffs? What's the impact there? A couple of the specifics here on taxes is, first I'll talk about tariffs, and this all leads right to corporate profits. Is with Trump's proposal of increase of tariffs on foreign imports, if you run a company that relies heavily on foreign imports and you expect the cost of those to be going up, well, as the management of that company, how do you adapt to that? Do you find another source? Do you try and find a local source, or do you just know you're going to have to pay more? And your line item of costs and cost of goods sold just went up, so your profitability comes down. This is something businesses who really are dependent on foreign imports care a lot about. NVIDIA is a great example of that. It's producing a chip that everybody needs. You know, when we are thinking about those kinds of products that have to be imported, it becomes very sensitive to have a potential tariff put onto a good that you're importing. So what would increase tariffs do to corporate profits? It would bring them down because the cost of importing that would go up until there's a lower cost or another replacement. Corporate tax rates are another important point here. The corporate tax rate, when Harris was running, was set to increase. And that's something that caused, businesses again to say, are we going to see our corporate tax rate going up or down? Trump has proposed further reductions in that corporate tax rate. Again, though, how do you pay for that? How do you pay for that from a deficit perspective? Can you, and is there an offsetting balance of revenue somewhere else? There has been a little bit of talk that tariffs are going to bring revenue in, and so therefore we can keep the tax rates low. It tends to not be that black and white. And a lot of times we get punished on another side where other goods get, increased costs and retaliation, essentially. And so we want to avoid that. But when we look at the federal corporate tax rate and the capital gains top tax rate, but I'll hold that for a moment, is that the global average of corporate tax rates is 23%. Our current is 21. That's part of the reduction that Trump instituted and the team back in, and the administration back in 2017. His proposal has been to bring it down another %. Now, that's not a massive change, but it's a pretty massive difference between what Harris had proposed. Either way, these do have to be passed by Congress. You have to have enough majority. And I think that our key here is going to be the deficit and how much we can do and where can it be done without significantly increasing the deficit. Now, if you're someone who's maybe not a fan of this administration, which I know exists, some people are out there, just kidding, you'd say they don't care about the deficit, that they're willing to spend and spend and spend. And worst case scenario, we just get this spending spree and then we have a massive deficit. What does that do? Well, sure, that's a risk if we just see a lot of spending that the deficit goes up. What ends up happening is you pay for that later. The market may not interpret that negatively today, but at some point, right, we have got all of the debt payment on that deficit, and that's where it really becomes a headwind. So I'm saying all of this to talk about corporate profits, because where corporate profits have an impact is in costs. So immigration ties to the labor cost. Tax rates tie to the corporate tax rate. Tariffs tie to what's the cost of the goods that we're importing to sell. And so if we see policy that is high, low, neutral, you can see here kind of the combination of these tilt towards lower corporate profits. The market doesn't love that. We have to wait and see what actually gets passed.
I think it's a good time to maybe talk about, given what we're seeing currently, knowing that there's still time required to see what actually gets traction, how should investors be feeling about their portfolios? We're kind of in this immediate, kind of reactionary period at the moment. We haven't seen the markets have big reactions quite yet, but if I'm coming to you and saying, as a portfolio manager, what is CNR doing for their clients as they're thinking about, the expectations for entering 2025?
And that's really important, right? Because there's been an interesting thing going on where we've had a strong economic data, and yet consumer sentiment has deteriorated. It's gotten a little bit better, but generally speaking, there's been this bifurcation between the two. And I think it's hard to turn on the news, hear about what's happening in the world, go through this election, and if it didn't go the way that you're supportive of, to not feel like everything's falling apart and maybe I should get out of the market. What we're really focused on is taking all of this data and putting it through the lens of investments and saying, what is the fundamental basis of investing? And it's really the economy. It's really whether or not the economy is growing or shrinking. And the economy and the markets have done well under both Republicans, Democrats, split Congress, red and blue waves, as long as the economy is growing. Now, of course, we want to be careful there. How's it growing? And are there long-term impacts? Of course. But the economic data today is actually pretty good. If you were to turn off all of the news and have no idea what's going on in the world, but look at the labor market, GDP, consumer spending, and where interest rates are and going, based on history, you would say this is a good time to be invested. When we look at some of this GDP data and we think about what we've been through just in the last 4 years, who could have imagined that we would have gone to such a contraction in GDP and rapid recovery, as if this kind of never happened? I mean, I know it happened. We were there, but it was much quicker. It was slower. It wasn't like 2008. 2008 was a prolonged recessionary period. We've had a strong bounce back. We've had wealth creation during this time because we've seen wages go up. We've seen asset values go up, home values, portfolio values, disposable income has actually gone up. Who would have thought that this pandemic and post-pandemic economy would have led to, on average, households being the wealthiest we've ever been? Now, that sometimes makes people nervous. And they say, well, that means a bubble's about to burst, and we're just about to go to a downturn. And that's why we're really focused on this economic data. Recent economic data has actually supported the fact that households are generally healthy from a balance sheet perspective. This is one thing that comes up that we want to be careful about, which is the personal savings rate, because we saved a ton of money in pandemic years and we've spent through that. As you guys have heard me joke before, we spent through that at the Taylor Swift concerts and the Chiefs games and everything else we're going to. So savings is a little bit down from pre-pandemic levels. We are seeing that disposable income still looks good. So what does this mean about how do we feel about our investments? If the economy is growing, then the companies that you're invested in, and when you're with CNR, of course, we're really focused on those high quality companies that we think can continue to grow. You don't want to get too worried. You want to focus on the fundamentals. And those fundamentals indicate that the economy can keep growing from here. So you should feel pretty good about your investments and not feel the need to have a knee-jerk reaction, particularly based on an election outcome. We can make adjustments over time, but we got to be careful about this sort of event-driven reactions.
We've been talking a lot about the US economy. We've been talking about indicators that are domestic as well. Let's switch gears a little bit and talk about international markets. I know that a lot of managers, including City National Rochdale, have been underweight or have zero exposure to international markets because it has lagged. What are the things that investors are monitoring there to think about when is the right time to gain exposure to more broader international markets?
Great question. Thank you. So, what's been happening globally is that the US has frankly had the strongest economic engine. And I've said this before, you may have heard it where I've said we're sort of the best house in a bad neighborhood. And so on a relative basis, we've been outperforming global markets. This is true year to date, but it's more so true over the last 5 to 10 years. The US has been able to have the most innovation, the highest GDP growth, and we've had fewer headwinds than other countries. As a firm, CNR, we are not invested directly in international markets, but the question is, when do they become attractive enough to step back in, as Lindsey's asking? And what I would assert is that we really think international markets have to be split up into segments. Now, there's a lot more nuance to where you might be invested internationally. When we think about Europe as an example, Europe relative to the S&P is underperforming by about 11%. But what's going on in Europe? We've had Brexit. We had a little bit harsher lockdowns than the US. We've got an inflation problem there that's rooted really in energy. Europe is 100% dependent on foreign oil, and they've got a war in their backyard with Russia and the Ukraine. That's not to say there aren't spots in Europe that are attractive, but as an economy as a whole, it's not that appealing. The other thing they have is they don't have much technology exposure in their indices. So someone might say on a price to earnings ratio, Europe is cheaper than the US. And that's true. But if you take out the impact of technology stocks, where Europe doesn't have that same exposure, actually they don't look as cheap. So that's something to think about. When we think about emerging markets broadly ex-China or emerging markets as a whole, this is where we think there could be an opportunity coming up that we might step back in when we're talking about Southeast Asia, India, when we see this sort of emerging countries into more developed countries. When we get back into international markets, you'll likely see this is where we'll go. China, on the other hand, has been all over the place just this year in terms of returns. This huge uptick was because China announced a massive stimulus program. And similar, maybe, I mean, it's not totally transparent, but similar to what the US passed back in 2020. But they've had 4 years, really 3 years of massive lockdowns, real economic compression. That's not even to speak about the fact that their population growth has really deteriorated from their one-child policy. Their ratio of male to females is off. They don't have enough women there for the number of men. We've got a bit of a population mess there as well. So when we think about global markets, there are spots around the world that we think could be interesting. Vietnam, India, some Southeast Asia. We're not there yet. That's probably where you'll see us move when we do. But for the time being, Europe and China, we're still avoiding, and that's really because of the economic fundamentals don't look better than the US.
Before we moved into fixed income, let's talk about some, spots, sectors, areas where you feel like there could be some good opportunities based off of anticipated policy changes or, other impact that the, changes in a post-election could bring.
Absolutely. So I love this topic because I have a couple other charts not in here that show what different sectors have done. during an administration. One thing that we are thinking about is sort of these sector themes. When you look at the trades, Democrat trades versus Republican trades, you see that the policy that tends to be supported by a Republican majority is beneficial to financials, defense, energy, materials. The sectors that the Democrat sector trades tend to go to is utilities, healthcare, industrials. What I would say, though, is that when you look at history, what you might be surprised to see is that during the Trump administration, renewable energy outperformed. When you compare the Trump administration renewable returns versus the Biden administration renewable energy returns, renewable energy did better in the Trump administration than Biden. Aerospace and defense was the opposite. So what we don't want to do is step away from the fundamentals and invest purely based on sectors that we think are favorable based on the current administration. It's more likely we'll add to a Republican sector trade because the Republicans have a majority, and we'll see if they use that for any significant policy change. That would be a reason to maybe increase some energy exposure or materials or defense. But often what you see, it's much more rooted in the fundamentals and kind of not as important what's happening in the White House. So that's the balance here. We want to be careful not to chase after what we think is going to do well because of the current administration.
Let's switch gears a little bit and talk about the fixed income markets. It's been an interesting topic for the past couple of years outside of the election cycle, but anything that's noteworthy to think about when we look at the kind of that space and what we're expecting going forward with interest rate changes and really there's a lot happening there. Not always exciting in the bond markets, but right now it feels like there's some things happening.
Isn't that the truth? The bond market, which is where the majority of investors have a significant amount of assets and yet gets talked about the least. These are where we get an income stream from lending to municipalities or companies. And they're a really important piece of client portfolios, particularly those who are living off of and taking withdrawals from their portfolios. Now, here's the thing about fixed income, is that historically, it has been the ballast to downside volatility in equity markets. Since 1980, when we've gone through the most painful tech bubble burst, 2008, bonds have been the place that the returns have been positive. In 2008, bond returns were up about 5%. We got used to this bond market environment where bond prices go up. Interest rates were low, so we weren't getting a lot of income, but they provided that downside protection. 2022 was nothing short of an earthquake throughout the bond market because the Federal Reserve raised interest rates so quickly. As interest rates go up, bond prices go down. Now, many of you know this, but it's a little bit of a complex topic from the vocabulary perspective. But basically, if I'm lending money and I'm going to get an interest rate that's 2%, I'm happy because I'm getting 2%. But if I find out that I can lend the same amount of money to someone else or another company and I can get 4%, then that original agreement that I had at 2% is worth less. So bond prices, as interest rates went up, any bonds that were purchased from 2008 to 2022, their value dropped. They're still paying that 2% a year, but the value dropped because of the relative nature of the interest you could get somewhere else. This is not all bad news because we have started to see bond price recovery. And in your portfolios, you're seeing these positive returns in addition to the income. It's not all bad news for those of you who are earning interest. And fixed income yields, this interest that's being paid, has actually recently repriced a little bit higher. So when you look across short term, and intermediate term, and then high yield, we can actually get some good yields off of the bonds in your portfolio. Uh, they tend to act as that higher level of income as a buffer for your portfolio returns. We're probably going to see some reduction in what these bonds are going to be paying over time as the Federal Reserve cuts rates, unless policy, economic data pushes inflation up, then we would actually see these yields stay higher. What we want to be careful of, and this is why at CNR we only work with great advisors like Lindsey and her team, is to build out portfolios that make sense for the underlying financial plan. Because a 5% CD or a 4% intermediate government bond sounds pretty good, unless we know that 4% is going to go 3.5 and 3 and 2.5 over time. Or if we're trying to combat a 3% inflation and we're getting 4%, we're really not getting ahead much in growth if that's the goal of your portfolio. So we still like fixed income. In fact, we think it's more likely than not to be a really positive contributor portfolios, but we still want to be careful here. We don't want to rush to those CDs and bonds because those yields look good today, because we do anticipate some volatility and decline in those rates over time.
Maybe now would be a good time to touch on gold, since we're talking about inflation and kind of flight to kind of that safety or security that is perceived to be in some of these asset classes.
Yes. So we get this question quite a bit. You can tell Lindsey read my deck before because she's asking me all the right questions that I have the answers to. But gold, much like any commodity, is priced based on essentially supply and demand, right? It's not priced on a cash flow that it's creating. Let me contrast that to Costco. I keep using Costco because I feel like it's very familiar to many of us. But as Costco has cash flows, has sales, has assets, is generating a return stream. And then there's supply and demand on top of that. But fundamentally, the company has value. With commodities or gold, it's purely what someone is willing to pay for it at the time. Gold prices tend to be volatile and are seen as a protection against inflation. But actually, when you look historically, they have not been the best protection against inflation. The best protection of inflation has actually been large cap stocks, because Apple, Microsoft, Costco, McDonald's, whatnot, these companies can raise their prices, pass those prices down to consumers. Their stock price can continue to go up, and that keeps up with inflation. With gold, it will only keep up if the buyers and sellers both have a view that then benefits gold prices. Where this comes from, I think, mostly is really not an investment strategy, because all the data indicates gold is not, over the long term, year to date it has been positive, but over the long term is not a great inflation protection. A lot of times it comes from the fear of central bank policy or government overreach, similar to where Bitcoin has come out and started to lead as an alternative kind of currency. So that's not to say that you can't have a little bit of gold in your portfolio. We're not trying to poo-poo that directly, but we do think that it's highly volatile, doesn't have a return stream that's based in fundamentals. And because of that, that equals a speculative investment. It's purely supply and demand, and that makes it more volatile.
Before we wrap up with some summarizing comments, are there any topics that we haven't hit on that you feel like would be good to address before we circle back?
Sure, absolutely. Let me just talk to you a little bit about our forecasts. And and where we see 2025 going. And our base case assumes that we continue to see positive real annual GDP growth. So we're looking at 2023, 2024, 2025. But you'll notice here, we do have a slight decline in GDP expectation. Not recessionary, still positive GDP growth. But we see that primarily because consumers have spent through the savings that we had saved up in COVID years. That there's likely going to be a little bit less demand. Not a significant change. In fact, we may not even feel this, but our estimations are that we see a little bit lower GDP. We do continue to see strong corporate profit growth into next year, and we think that inflation probably doesn't see a huge decline. Why is that? Demand is still strong, labor costs are strong. The administration policies may push a little bit of that inflation expectation up. So it's not bad, still in that 2 to 3% range, but that's still higher than the Federal Reserve would like to see it. So the Federal Reserve will want to keep cutting rates, but they're likely going to cut them at a slower pace, where we're not expected to go back to those really low 0% type rates. So I say all that to say there's a lot going on, but our base case is that economic fundamentals would indicate 2025 should be a positive economic year, barring a geopolitical shock. We don't think the outcome of the election is going to derail this. There's just too much good economic data that should get us through 2025.
Great, thanks for summarizing that at the end there. So what I've heard you say is largely, there's still a lot of unknown as we continue to move forward. What we're monitoring the most from the new administration is really going to be tariffs. So I'm sure that's no surprise to anyone on the call. And then immigration and how that's really going to impact corporate profits when we think about it from a market or an economic standpoint. Outside of that, there are some positive things that could come from lower taxes. So keeping in line or, from where we're at with the current tax rates on both the personal and the corporate side, that's kind of some positive impact. And then like anything else, there's always going to be opportunities within the markets for different sectors or areas where we might tilt to based off of what we're seeing from anticipated policy changes or shifts that the administration could bring.
Absolutely. That's a great summary there.
What other comments would you, and I would just say, let's just talk to the nervous investors out there. Let's just have a direct conversation and say, if I'm feeling nervous about my portfolio, Rachel, what are you going to tell me so that I can feel, a little bit better about what's to come, other than I see that we're expecting, still a lot of positive things from the economic standpoint.
Yeah. And, this is one of those times where it's really important to differentiate between what matters to investments and then what matters more broadly. So if you're an investor and you're a client where the election didn't go the way that you would prefer it, and you're concerned about the outcome of the administration policies, if you can think about differentiating between the economic impact and the social impact. The market basically ignores all of the social policies of any administration. That's not to say they're not important. Of course, they're very important. But if we can put those to the side and look at the economic policy, one of the reasons why you hire Lindsey and the McKay team and then money managers is so that you've got hundreds of people digging through all of this policy to say, okay, what is the impact and which companies are going to be able to get through this smoother than others, and how to invest in those companies. What bonds are going to be best in this environment and how do we invest in those? And then most importantly, Lindsey, you hit the nail on the head when you said, where are the opportunities? No matter what is happening in the market, good, bad, indifferent, there are always opportunities. And our job, and why you're hiring a team and a firm to do this, is to spend the hours and hours every day with specialists and expertise to determine what it is. So if you can, I would separate the economic impact, give it a little bit of a breath to say we're going to have to wait and see. What we don't want to do is ever have a knee-jerk reaction to an event like an election, and to look around. If everywhere you're going, the restaurants are full, the airports are full, the concert tickets are sold out, you know that this is a pretty good economy. That's not to say we don't have our issues. We have our issues, but it doesn't mean that that's time to get out. History would tell us that the economy and the markets grow under both Republicans and Democrats. We have seen a Trump administration before with a Republican majority, so we have a semblance of a playbook of what it might look like. And so we're going to be able to see corporations react to that, and as money managers, find those opportunities in this environment.
We do have a couple of questions that we haven't gotten to. It's really, the first one's about just when will we start to see changes? And I think that's sort of, the last comment that you made there of just we've sort of know, what this is going to look like. And the good news is that nothing is ever seems to be fast in the political system, right? But we talked earlier about what are the biggest risks that we are still concerned about, and that's geopolitical risks, because those things can happen really quickly.
Right.
And it'll be, something where it's a large event that has, kind of not a lot of time to prepare for. Where when we're seeing things that will get passed from a legislation side, that is a process, and there's lots of lead time where there's the information that's shared. We get to see sort of the trend of where it's going. And so, the question is it'll take time, I guess, to start to see those things unfold. And that gives the market and portfolio managers, investors time to react. So it's not something where you can sort of see where we're headed and make adjustments, as opposed to feeling like this came out of nowhere, I didn't have time to make those changes. Any comments that you'd want to add to that, Rachael?
Yeah, so the market is like a little tugboat on an ocean, right? It goes up and down constantly. So if it's up, is it because of the election, or is it because of the Fed meeting? Is it down because of the administration or Trump tweeted something, or is it down because the labor market came out? It can be all over the place. So we want to step back and say, what's normal market volatility? If the market is down or up anywhere in that 10 to 15% range, down 10, up 10, that's very normal. It's not reacting necessarily to any structural change that can happen anytime. When we think about economic policy, it filters through in time. But companies can react. Companies can react to, how do you make money under this regime, under this tax regime? One of the key points we're going to see corporate profits continue to stay elevated is the ways in which companies use technology to circumvent potentially some costs that come either through the administration, the Federal Reserve, or whatnot. So you don't necessarily see the market react as you think it might, because there's a confluence of data all coming in at once. It's the longer term where you see the impacts, and that just takes time.
Well, we are at the top of the hour, so do want to be mindful of Rachael's time and everyone else on the call. There were a couple of questions that we weren't able to get answers to, but for those of you that posed those, if you want to reach out to us directly, I'm happy to respond back with those. So Rachael, thank you for your time. I think my comments to end would be like much more to come. Some of the questions that we didn't get to was, what have we considered in putting this presentation together? Well, there hasn't been a lot of time between the end of the election and pulling the presentation together. And so that's why I think there's going to be lots to talk about as we kick off 2025 and start to get into the first quarter of the year, and really start to have a lot more clarity about not only what's being said, but what's actually coming to fruition. And I think that's the biggest thing when we come out of election cycles is, what's really going to be taking a foothold as opposed to, just sort of a lot of rhetoric out there. So I'm sure we'll be having a lot more conversations around these topics. So look forward to those with you, and thank everyone for joining us today. And for those of you that we don't get a chance to talk to before Thanksgiving, I hope they have a wonderful Thanksgiving holiday, and we'll look forward to connecting before the end of the year.
Thank you. Thanks, everyone.
Thanks, Rachel.